just to give you a bit of an overview in terms of the journey that MODA and CHL have been on and are looking to go on. Some of you may be completely brand new to us, which is totally understandable. I don't think that you would actually be able to access us via MODA just yet, but I'm pretty sure you can via CHL. So today really is just kind of an opportunity for, like I say, me to introduce myself, to sort of refresh on the brands, kind of where we are, and sort of how it's all come about, and sort of how we can move forward and hopefully help more of your clients with their buy-to-let needs. So I'm just going to share my screen. So give me 1 second. Can everybody see that?
Yes.
Oh, yeah. Okay, cool. Right. Let me just start the slideshow. Right. So I'm just going to it's quite a nice visual just to sort of go through some bits, but ultimately, if there's any questions, I mean, I'm really not bothered. Please feel free. If there's something that's really, pertinent on your mind while I'm talking, please feel free to interrupt me and ask. But if you want any questions at the end, there will be time. If there's anything that I haven't covered, or you sort of want to go through, then please utilize that. I will make sure that you have all my contact details following this presentation today. So if anything comes up post this, then please feel free to give me a call or drop me an email. Okay, so basically, as you can see here, there's now two ways about it. So we've got here MODA Mortgages and CHL. So some of you may already be, and hopefully will be, familiar with CHL. I know that they are on panel with you guys, so you may have used them in the past. But just to give you a little bit of background, so in the middle there, you can see Chetwood Bank. So Chetwood are the bank that own MODA and CHL. So they're based in Wrexham, North Wales. They've actually been around, the bank have, since 2016, but they decided a couple of years ago that they wanted to move into secured lending because they've got quite a large savings book. They've got about 5 billion on savings balance that they generate through their savings accounts. So from that, they built and launched MODA Mortgages. So that has been built from the ground up, and that launched in January this year. So it is very, very new to market. In the specialist buy-to-let space. But I'll be honest, MODA did take a little bit longer to come to market than I'd hoped. So Chetwood were doing some forward flow arrangements with other lenders, and CHL were one of them. And then CHL actually approached Chetwood about buying them last year. So they purchased them in May 24. So they essentially have now got the two buy-to-let lenders. And it was kind of a case of, okay, what are we going to do? Are we going to keep them both? We're both in the specialist buy-to-let space. Do we need to? What's kind of the plan? So they've decided that we are retaining both of the lenders and the brands. But the good news is in reference to, there's now two ways about it. I'm dual branded. So I look after MODA and CHL. And the reason we've kept them both is because MODA is more on the simple, straightforward side with some nice little quirks in there. And then CHL is more on the complex side when it comes to limited company structures, properties, applicants. There's more flexibility with CHL. So across the two brands, we really feel that we can cover kind of most areas. And it's great from my perspective that I get to look after them both. So any queries or questions that come through to me, I can look at it with two hats, and hopefully, like I say, between the two, we should be able to help. The other reason for keeping them separate as well and keeping both brands is for future. So with MODA, we have requested for our resi permission. So we are looking to move into specialist resi in the future. And then with CHL, in the more imminent future, we are looking to launch with bridging. So CHL, we are going to take down more of the complex commercial route. So launching, starting with bridging. We've got our refurb product, which is coming back, which I'll touch on a little bit more later. And then also potentially looking to go into semi-commercial and full commercial. So the two brands and the two lenders will have their real identity sort of in the fullness of time over the next 12, 18 months as further asset classes and different things launch. But for today and for today's purposes, they're both in the specialist buy-to-let space, but as I say, at different ends of the spectrum. And what I'll do now is just give you a little bit of a flavour in terms of some of the key highlights and key areas that we can help your clients. So just to give you a quick overview, you can see here, these are some of the distinct differences. So with MODA, like I say, it's more simple everyday buy to let. So, but within that, we have got some nice little quirks. So we've got first time buyer, first time landlord, and I'll go through some more kind of detail around that shortly. We have free valuations on everything across the product range with MODA. So whether it's a small HMO or multi-unit or limited company or standard buy to let, everything will get a free valuation on MODA. All pound for pound remortgages are stressed at pay rate. So that gives a little bit more around affordability, especially if they're looking at a 2-year. So there's no additional stress on the 2-year if it's a pound for pound remortgage. As you can see there, we'll do small HMOs and multi-units. So we'll go up to 6 beds and 6 units. Day one remortgages, so this is a big one. We've moved into this space in the last couple of months. So MODA can do day one remortgages, bridge exit and cash purchase at full market value. And again, I'll explain a little bit more around that and some examples. We can look at minor adverse, and MODA can also do top slicing. And then on the CHL side, when that goes into a bit more complex, we can look at complex limited company structures, so layered limited companies, subsidiaries, trading companies, LLPs. Pretty much there isn't much we can't do when it comes to complex limited companies on the CHL side. The large and complex HMOs, so they'll go up to 10 beds and 10 units, and also some quirky little structures, which I'll go through in a little bit more detail. You can see there, obviously, the multi-units with shared facilities, and if they've got units that are below 30 square metres, then we can look at those as well on CHL. Blended ICRs, so if you've got properties that are owned tenants in common and you've got a high rate taxpayer and a lower rate taxpayer, we can, depending on kind of the percentages that property is owned in, we can blend the ICR to get more affordability out of those properties. Again, CHL can do day one remortgages as well, and that's cash purchase and bridge exit. Minor adverse, so CHL will do adverse as well as MODA, but they will do a little bit more recent. And like I say, I'll give you some more examples of those. And a big one for CHL is short-term lets, so serviced accommodation, Airbnbs, booking.com, that sort of thing. So that just gives you a little flavour. What I'll do is I will go through now. Just trying to move it forward. So we'll break it down brand by brand. So I'll start with MODA and just give you a bit more detail and an overview of the things that we can help with. So first time buyer, first time landlord. So a couple of key things to be aware of with this is we do need a minimum income of 30,000 from one sole applicant, and it needs to be a standard property if it's a first time buyer, first time landlord, as any HMO or multi-unit does require 12 months buy-to-let experience. But we can do first time buyer, first time landlord in personal name and in limited company. And the great thing is it is an actual asset-based lend. So we don't look at any kind of resi underwrite or affordability in the background. It's purely based on the rental, as long as they meet the minimum income and it's a standard property. Just on the income side with MODA, so we don't have a minimum income unless it is a first time buyer or a loan over $1 million. If it's a loan over $1 million, then we do need a minimum income of 100,000. But unless it's those two scenarios, we don't actually need a minimum income. We just need to make sure there is a income in place. And that can be purely from land and property. You can see there, and as we've already said, we'll do limited company. So we'll do that under MODA. It is a bit more simple, straightforward. So your standard SPVs, your standard 686 codes. We can do intercompany loans and directors' loans by way of deposit, but we do need to make sure that the majority shareholding does mirror it if it is an intercompany loan. One thing that we have improved with the limited company side on MODA is we can now accept small or simple layered companies. So if you basically got kind of like one up, one down, it's very simple, straightforward in terms of the ownership and the shareholding and director. We can look at that now on MODA. And also as well is we can, as long as we can capture 75% ownership on the application, any non-director shareholders with 24% or less shareholding, we can actually ignore them off the application. So maybe if you've got kind of mum and dad and 2 children in the background, but with a small shareholding, as long as the shareholding kind of fits and we get that 75% coverage, we can ignore those kids. So that just gives you a little bit of a flavour in terms of the limited company side on MODA. Portfolio landlords. So absolutely welcome portfolio applications. Just some key things around this. So we don't have any limits in terms of the background portfolio. They can have as many properties as much lend. We do stress the background portfolio. So we stress that 125 at 5. But the key really is with the portfolio is we just try and make this as straightforward as possible. So we do require an application for each property. So if there are multiple properties that you're looking to bring over to us, it would be an application for each one. However, if they are in limited companies, we do have waivers. So we have ILA waivers. So we'd only need one lot of ILA across all the applications. And if they have already had ILA with MODA in the last 6 months, we wouldn't need them to have it again if they came back to do another application. They've already done one with us. We'd always make sure that with any sort of portfolio lens, we've had a couple in the last couple of weeks. So we'd get you to do one application first. All the documents would be added to that application. That would go through full underwrite to make sure that we're happy with the applicant and the sort of overall deal. And we would then get you to submit the following applications after that. We would be able to transfer all the documents over, and obviously it would always go back to the same underwriter. So it would be a portfolio underwrite. So it just makes it far quicker and easier. And again, if an applicant has already been underwritten, and then you come back a couple of months later for a further application, we would always make sure that goes back to the same underwriter, just to make sure, that we've got some speed and ease around there. And where we can use documents that we've already got on the system, we absolutely will. It just depends on the timescales. And then non-prime. So as I said, we will do a little bit of adverse with MODA. So what I would say is it's nothing really heavy and nothing that's recent with regards to CCJs or missed mortgage payments. So for example, we wouldn't accept any CCJs in the first 2 years, but we can accept one in 36 months. With regards to mortgage payments, so we couldn't accept anything that was missed in the first 12 months, but we can accept a worst status of 2 in 36. So it just gives you a little bit of a flavour. If it's unsecured, so maybe utilities or communications, then we can accept a worst status of 1 in 12 months. We can go up to a worst status of 3 in 36. So there are blips and things that we can accept, but essentially, if you want to just sense check anything, send me a credit report and I can have a look to see where it would fit. But the great thing is with MODA is actually, if they do fall into the non-prime category, they don't actually, it's not like they would have a higher rate of interest. So the same rates apply. There'd just be certain elements of criteria that they wouldn't be eligible for, top slicing being one of them. So if it's a non-prime applicant, we wouldn't be able to use top slicing. So just on that, so top slicing, we can obviously do under MODA. What I would say with top slicing is we do need to make sure really that the client has got a very healthy disposable income and a good income, because ultimately if you get into the top slicing where we're looking to use their disposable income to top up the rental, then we will be looking at a bit more of a resi underwrite. There will be more affordability checks and there will be looking at stress with regards to like the ONS data and things like that. So just a bit of a caveat with the top slicing, but we can do it and it does work, in a lot of instances. So then I'll just give you a little flavour just in terms of the types of properties MODA can help with. So as I mentioned, you've got your HMOs and your multi-units, and you do get your free vals on that. So HMOs and multi-units will go up to 6 beds and 6 units. With your HMOs, we can accept quirky little structures like if they've got 2 kitchens, if they've only got 1 kitchen and no other communal area, that's fine. They've got locks on all the doors and en suites in the rooms, a bit more like student letty, then we can accept those types of structures. And from a rental perspective, we will value these on a room by room basis. With the multi-units, like I said, we'll go up to 6 units. We value these on an aggregate basis, so that tends to work out a little bit more favourable. And we do need to make sure, though, that each unit does have a minimum square metre of 30 square metres, and we can't accept shared services on MODA for multi-units. So we can do ex-local authority properties. So we don't have any sort of predetermined percentage in terms of the private ownership. We just rely on the valuer to confirm that this is suitable. If it is exceptionally low, though, what I would say is always kind of refer to me first and we'll have a little look at it. I mean, it is a free val, but there is an application fee. So if we know that we're not going to be comfortable, then obviously we'll tell you from the outset. We can do high-rise stories. We'll go up to 20 stories. But we can go above that if it's city centre and the value of the flat is so, potentially, I know we're seeing some blocks in Manchester and stuff going up and they're like sort of 40, 50 stories. We can consider those properties on an exceptional basis. But as standard, we'll go up to 20 stories. And we are getting a lot of questions around ground rent and service charge. So we don't have a sort of predetermined amount or percentage built into our criteria. Again, we just rely on our valuer to confirm that this isn't onerous and that it's not going to affect any potential onward sales should, we need to repossess. So that's been really positive. A big one for MODA is properties above and next to commercial. So I'll go through this in a bit more detail around the types of properties that we have accepted. But we can do these properties up to 75% loan to value. And new build houses and flats, we can also do up to 75% loan to value. So we'll just... Okay, so 80% loan to value. So we do have 80% products and we can do those on standard properties. We can do them on HMOs, multi-units. And we are seeing a lot of these now where people are looking to sort of remortgage, capital raise and grow their portfolios and look to get as much as they can out of the properties. The 80% product is doing really, really well, to be fair. So we've got that on 2-year and on a 5-year. So as I've mentioned, we've got free valuations, but the real pertinent point is around the HMO and the multi-units. Very few lenders are offering this, and we are seeing quite big savings for applicants when it comes to these types of properties and having the free valuations. As I mentioned at the beginning, so we only stress our pound for pound remortgages at pay rate. So basically, if they are looking to do a pound for pound remortgage, no capital raise or any additional borrowing, then we will stress these at pay rate, whether it's a 5-year or a 2-year. If it's a standard purchase or it is a remortgage and a capital raise, then we will stress our 5 years on a pay rate, and our 2 years we will stress at pay rate plus additional 2% or minimum 5.5%. And you can see there that our stress rate, so for basic rate taxpayer and limited company, it's 125, and for higher and additional rate, it's 140. CHL as well. So as I mentioned, top slicing. So I think that the key thing really here and the caveat is just to make sure that we do, or your client does have a good, healthy disposable income to be able to look at doing this. But the system will do all kind of the ONS data and the maths behind it. So if you do have any applications like this or you need any support or help, please just reach out because, like I say, a lot of the stuff goes on behind the scenes and our underwriters can help sort of break this down and have a look at it to see whether the applicants are eligible to be able to utilise the top slicing in their income. And then, as I mentioned, so properties in and around commercial. So I've already said that we've got the free valuation, so that is that's a big help. But ultimately, we don't want to be wasting any application fees. So what I would say with any of these properties is please send them over. If you've got Street View, then we'll have a look at it and we'll have kind of a sense check to see what other types of properties we've done. But essentially, we look at the quality of the property, the quality of the area, the commercial that's surrounding, and we have done them, as you can see, where they've been above cafes, next to a restaurant, near to a pub, and also next to a railway. And just so that you're aware, we use Gateway for our valuers on MODA, and they tend to have a little bit more of a better risk appetite for these types of properties and a bit more of a flexible approach. So that's where we have had some success. But any queries or questions around that, please just send the property details in and I can have a little look at them to see whether we can do it. If it is a property that is directly above or next to a pub or a takeaway, then it would be a no. But we have done them where they've been in the vicinity, or maybe, 4 or 5 stories above, especially if you're looking at kind of like central city locations, like central London and suburbs and things like that. Okay, so I'll just pause there just for a second. If there's any questions around what I've gone through with MODA and some of the criteria points that we can support. No? Cool. Okay. So CHL, so as I mentioned, so they are more, and some of you may already be familiar with CHL. So CHL are obviously the old capital home loans. So they were capital home loans pre-2008. Then in 2008, they sort of disappeared, and then they came back as CHL. So, and I think, to be honest, they came back, but they didn't come back with the kind of gravitas that they left the industry with. And they've been a little bit under the radar, really. So what we're trying to do and what we really want to do is sort of reignite, some of the great things that CHL can do now that they're under the Chetwood Bank banner and they've got that more stability. So CHL have got a very holistic approach in terms of their underwriting and their lending. So MODA is a bit more, as I said, simple, straightforward, black and white. CHL can kind of have a look in the grey areas. If you've got kind of 9 out of 10 criteria points that tick all the boxes, but there's one that just falls out, we can still look at that. A big one for us is our decline dips. So we actually have a dip decline team now who review all of the dips that come through as a decline, and we actually contact the brokers to review the case. And I'd probably say sort of 60 to 70% of those are able to progress forward. There may just be sort of credit things in the background that we can actually overlook or overturn, and we can actually progress those cases forward. And then similarly, where things maybe don't fit with MODA, then they can fit in with CHL. So there is a lot more holistic and a lot more flexibility approach when it comes to CHL's lending. So just to give you a little flavour of some of the things that we can do there. So the limited company side. So basically, as I said, there isn't really much we can't do on the limited company side with CHL. So we can look at new limited companies. A big one is trading limited companies, limited liability partnerships, where some lenders won't look at these. We can pick those up. If they are looking to do intercompany loans and the majority shareholding doesn't mirror, if there's multiple layers, multiple subsidiaries or holding companies, where we have to draw kind of diagrams to understand what's going on, CHL can look at those. So where it gets really quirky and complex, that's where we really come into our own. Also, similarly to MODA on the percentage side, so as long as we can capture 75% ownership within the application, then we're good. We can ignore any non-director shareholders with 19% or less shareholding. So it does have to be a slightly smaller percent shareholding with CHL because we can look at those more complex companies. Blended ICR. So as I mentioned, if we're looking at tenants in common, then we can look to blend the ICR to get more affordability. And I've got some slides which will kind of just bring that to life a little bit more and explain how that kind of works. Portfolio landlords, so CHL, so in exactly the same vein as MODA, just want to make this as simple and straightforward as possible. So the ILA waiver applies in terms of everything going to the same underwriter, documents only being uploaded onto one application, all of that applies. Obviously, having no limits in terms of the background portfolio. And I did forget to mention, so with MODA and with CHL, so we have a max 10 million lend. So that would be across the 2 brands. So they could have 5 with CHL and 5 with MODA, but essentially we can go up to 10 million with kind of MODA or CHL. So the HMOs and the multi-units, so we'll go up to 10 beds and 10 units. So we'll do the more kind of complex properties, and anything that is above 6 units or 6 beds will trigger a commercial valuation. And we do this through Allied. And this is to make sure that we're getting like a sort of a true value of these types of properties and a true understanding, because they are kind of more commercially minded. Short-term lets, so this is a real big one. So this is kind of your Airbnbs, your booking.coms, your holiday lets as well. So just to be mindful with our short-term lets, we do value these on or assess them on a single AST basis. So we do have to make sure that there's demand for these types of properties on an AST basis, and obviously that the AST fits. So we don't look at low, medium, high at the minute. So sometimes with the true holiday lets, it does fall out. But we do pick a lot of this up around sort of the Airbnbs and the booking.coms as well. On the multi-units, so we can do units that are under 30 square meters. So we can do studio flats, but also when it comes to, like, we get asked a lot around, if you've got multi-units that have maybe got 2 or 3 bigger units, but then they've got one that's a studio that's below 30 square meters. MODA wouldn't be able to do that, but CHL would. And they can also look at shared services as well. And CHL can also pick up the ex-local authority side of things too. So just to give you, as I mentioned, the ICRs on CHL are exactly the same as MODA, so 125 for limited company and basic rate taxpayer, and then higher and additional rate is at 140. And then with regards to the assessment rate, so on a 5-year, it's pay rate; on a 2-year, it's pay rate plus 2 or 5.5%, whichever is higher. So just going to click forward because we've got a video, but I won't go through that. Just going to see if I can get through that. There we go. Oh, is it going to let me? Ah, there we go. So basically what the video explains, which is just everything that's on this screen here, is this is how kind of the blended ICR works. So you can see here you've got standard property, which is owned 50-50, and you've got one of them is a high rate taxpayer, one is a lower rate taxpayer, and we would always go on the higher rate. So therefore the maximum loan would be 206,956 on this property. If it was owned tenants in common, 50-50, then we would be able to blend the ICR with the 125 and the 140. So that would give us a blended ICR of 132.5. So it gives a higher max loan. And then but then if they were tenants in common and the high rate taxpayer only had 1% and the low rate taxpayer had 99%, then that gives us the ability to have more of the ICR leaning towards 125 as opposed to the 140. So that gives the higher lift there in terms of the max loan at 231. So that's how the blended ICR works if you've got any clients who've got these types of properties and want to take advantage of that really in terms of getting more affordability out of the property. Okay, so as I mentioned, so these are just gives you an example here really of some of the types of structures that we can consider. So where it gets sort of like really complex with regards to the limited company structures. But all I would say is if you've got anything that you want to just sense check, send us the company details. We can look on Companies House. We can do a sense check as to whether we can look at it and make sense of it. And then we can give you some guidance. So just to give you a little bit of a flavour in terms of some of the quirky properties we can do. So as we mentioned, we can do large HMOs, large multi-units, but we can do hybrid properties as well. So as you can see here, you've almost got like a bit of a kind of like HMO multi-unit. So you've got 2 self-contained flats, but you've also got 4 rooms in there that are rented out on a room by room basis. We can do those types of properties. Okay, if they've got shared facilities, we can do those as well. And then this is a real kind of like quirky one. You maybe don't come across these very much, but it just gives you kind of like a flavour of the types of things that we can do. So as you can see in here, you've got 2 short-term lets within this block. And then you've got kind of 6 rooms there that are being rented out on a HMO basis. And they've all got en suites. And potentially even sometimes they can all have, just go back here, they can all have kitchens as well. So we can do them with kitchenettes. So like I say, you probably don't come across these types of properties very often, but we are seeing more landlords sort of move into the space, especially around the multi-unit where they've got a couple of units on Airbnb and they've got a couple of units on a single AST. So those kind of multi-use types of properties or complex structures, we can look at those. So where landlords are trying to get a bit more yield out of their properties and do a few more quirky things, those are the types of things that CHL can pick up. And as you can see here, with regards to the multi-units, then we can do shared services. We can do them where they've got holiday lets in some of them, or short-term lets in some of them, or if they're on ASTs. And we can also do them if they are below 30 square meters. So that just gives you a little flavour. What I will say as well is just on the CHL side that we didn't cover off is the around the adverse. So CHL can do more recent adverse. So they can, with regards to, like, say, missed mortgage payments, we could go up to a worst status of 2 in 12 months with a CCJ. We can look at 1 CCJ in the most recent 12 months. So we can't do anything that's really heavy, but we can do things that are more recent, and we can overlook things with CHL around the sort of miscommunications and sort of utilities, things like that. So so that just gives you a little bit of a flavour in terms of the types of things that MODA can do. I hope it kind of just puts brings to life a little bit more around if MODA's brand new to you, how we can help. And definitely some of the key things there, I would say, is your free valuations, your day one remortgages at market value, the smaller HMOs and multi-units, especially on our 2-year rates, because they are fairly competitive right now. And obviously your first time buyer, first time landlord, as well as your properties in and around commercial. And then your CHL, it's where kind of those more complex, where there is more recent adverse, sort of your larger HMOs, your quirkier types of properties and limited companies, where that really sort of fits in. But the great thing is you don't need to kind of think, oh, you don't need to be like, oh, is this a MODA or is this a CHL? Just any queries or questions that you have, pick up the phone, drop me an email, and we can sort of talk it through, and we can see sort of where it fits and where we can best help. So over to you guys. Any questions or anything that I haven't covered off that will be helpful?
And it's going to be me
Hi.
first. Oh, there you go. We've got one.
Hello, hi Michael. Yeah.
Hello. Yeah. So I put a question in the chat, so you can see it. I don't know if you can pick up the chat.
Let me have a look.
There's another one there as well.
Oh, there you go. I'll cover this off, Beck. With first time buyer, first time landlord, can the 30,000 minimum income be satisfied with 2 separate incomes from 2 directors?
So ideally, we do need the minimum income to be achieved by 1 applicant. So, but if you've got, let's say you've got one that was really close to 30, like if they were close, then we could consider it. But I think ultimately we do want to try and get as close to the 30 on one. But I do hate saying no to anything. So if you think that there's kind of like it's a good sort of proposition in the background, then please let me know. But ultimately, we have done them where it's been kind of like 28, 29. So yeah, just kind of that would be a bit more on a case by case, but ideally 30,000 from 1 sole applicant.
Thank you. I think there's another one in there as well from somebody else.
Yeah, I'll just read that out. Cheers, Michael. From Bob, what's the minimum remaining lease length required?
Okay, so with CHL, it's 75 years at the end of the term. With MODA, it's actually 50 years at the end of the term. So with MODA, it is a little bit more, it is a little bit less. And we have picked up quite a few cases with having that sort of shorter lease length at the end of the term.
Next question from Hasnan. Communication default in the last 6 months are ignored or looked at their value?
So general rule of thumb is no defaults, and definitely none with MODA in the first 12 months, and really none with CHL in the recent 12 months. However, if it is a communication and it's a very small amount, there is potential that we could overlook that. So we would, I'd happily have a look at a credit report for you. That general rule of thumb is none in 12 months on defaults, but yeah, I would say £48 communication. Let's have a look at it. Can't make any promises, but I've definitely seen them overlooked.
Cool. Another question from Bob. Would you do properties which need a light refurb, i.e. not ready to rent on day one?
So we can do them as long as it's very light. If it's just kind of like general decoration, so just needs a lick of paint, a new carpet, as long as it's basically it needs to be lettable within 30 days, that would be okay. And that would obviously be confirmed by the valuer that, you know, the property is in that sort of state. We are actually, so I'm glad you've mentioned this. We are bringing back our light refurb product with CHL, but that's where more of a refurb is required. So essentially, if the property was not lettable and needed maybe new bathroom, new kitchen, we could look at a term product where we would lend you the money to buy the property in its current state, and then in tranches lend the money to do that light refurb in order to then we'd be able to then lend on the market value that it would be once the work's completed. So that's more in a situation where there is more required in terms of like the kitchen, bathroom, things like that. But if it is just a lick of paint and a new carpet, that's fine. But we do have that 30-day kind of, it has to be lettable within that time frame.
Shauna, you've got your hand raised. Was that accident or was that a question?
No, it was a question. So I'm very newly qualified. So this is all sort of new to me. I'm based in Scotland. Is the same guidance for Scotland than what you've said, or because I know Scotland have got sort of slightly different rules and things. So
yeah. So I'm really sorry, Shona. We don't lend in Scotland on MODA or CHL at the minute. So if you're looking at any properties, England, Wales, that is absolutely fine. So it doesn't matter that you're in Scotland. It's just we couldn't do any properties that are in Scotland as it stands at the minute. I'm sorry.
Right. No, that's totally fine. I think I'll be concentrating on obviously Scotland now, but I'm just training.
Yeah, absolutely. I totally get it.
I think that's it.
Cool. So just a couple of other things that that do tend to come up. So I will just before we finish. So like minimum property values, 75,000 for both. Minimum loan is 25,000. Like I said, MODA use Gateway for valuers. For standard valuations, CHL use Connells. And I know some people sort of screw their nose up at Connells, and I do get it. But we have actually done a lot of work with Connells recently to completely revamp our valuers guidance notes, and working really, really closely with them in order to get them on board with understanding what our risk appetite is and making sure that they're valuing to that. So and you know, we've kind of tasked them and challenged them with, you know, with making sure that they stick to that. Otherwise, you know, we're going to be in talks as to whether we continue to use them. So I know that sometimes Connells can put people off, but like I say, we've done a real big piece of work to really hopefully enhance that experience. So but CHL use Connells for standard, and then they use Allied for their commercial vals. And just from an exposure perspective, so if we're looking at sort of flats in a block, MODA can, so anything up to 4. So if it's a small block, MODA could do 100% of that. If it's anything above that, they could do 20%, whereas CHL could actually go up to 10. So if there's a block with 10 units in, CHL could do all of those. Anything above 10, then they would do 20% again, or 10, whichever is higher. So they're just some of the kind of like little questions that come up that I just thought we'd cover off.
Cool.
But yeah, essentially, whatever you need, guys, I'm here. So please, I really want to help. We'll get engaged with you guys. You won't be able to access MODA as it stands at the minute. I'm sorry, just because we need to get all the paperwork and stuff. There we go. There we go. That was like a shameless plug to Ryan. Please get that signed so that we can.
I've had it printed on my desk for a while.
Amazing.
Do it.
Do it. You guys can get you guys can access CHL. So what I would say, so you're all so you're registered with CHL. So we just need to kind of like, what I'll do is I will send an email over to Ryan just to sort of, so he can send it on to you guys in terms of if you're not registered, you want to get registered, kind of what the process is and everything. And also to make sure that you guys have got my contact details what I will do is I will just really super quick. Let me just dump it in the.
I was just doing that then. I thought,
Oh, were you?
And then I thought, oh, you're going to send me an email, so I'll forward that all to the network if you want as well.
Okay, cool. Well, I've just dumped it in the chat, so it's in there. You've got my contact telephone number and you've got my email address. So my email address is beck.murray@chetwood.co. There is no UK. So that is right. But yeah, just email me, and then as soon as you're all set up with MODA, I'll get an email over to you via Ryan to so that you guys can all get registered and then start using us.
Perfect. Thank you very much, Beck. Appreciate it.
Amazing. Thank you, guys. Crazy to say it, but have a great Christmas. And yeah, and then just I'm here if you need me.
Brilliant. Thank you very much.
Thank you.
All right. Thanks a lot. Take care.
See ya.
Bye-bye.
Bye. Bye.